Hello and welcome to the J. Mike Mortgage channel. And on this episode, the mystery of Schedule C income. Most borrowers and even some loan officers have absolutely no idea how a mortgage lender will typically calculate income for a Schedule C self-employed borrower. So I'm going to show you, and I'm going to make it easy. But first of all, I need to mention a couple of things. This video is made for someone who intends to get a conventional conforming mortgage, something underwritten to Fannie Mae or Freddie Mac guidelines, an FHA Federal Housing Administration mortgage, a VA Veterans Administration mortgage, or USDA U.S. Department of Agriculture mortgage. These mortgage types make up the vast majority of the market. However, there are some specialty loan programs out there that may calculate Schedule C self-employment income differently. And then finally, I need to mention that mortgage guidelines give the lender some flexibility in calculating Schedule C self-employment income. So I can't promise you that the formula that I'm going to show you is the exact same one used by every mortgage company, but it should give you a number which is close. I'm going to go over this in 4 sections. Initially, I'm going to explain what Schedule C self-employment income is. Then I'm going to go over the inherent conflict between the tax preparer and the lender. Then I'm going to explain the 4 easy steps on how the lender calculates Schedule C self-employment income. And finally, I'm going to mention a few things that you need to know about this subject. So what is Schedule C self-employment income? To make a long story short, if your tax return contains one of these forms here, a Schedule C, profit and loss from business, and the income you need to qualify for the mortgage is on this form, then you are Schedule C self-employed. Your income is reported to you on a 1099 form and not a W-2 form. No taxes are withheld from your paycheck, and you're considered an independent contractor and not an employee. Based on my own personal experience, one of the biggest problems that I've had with Schedule C self-employed borrowers is the inherent conflict between their tax preparer and the mortgage lender regarding how much net income they show on their Schedule C. The tax preparer thinks that their job is to reduce that net income to the lowest amount possible. So they'll take every possible deductions because that way, if they can get that net income down, you don't pay much in income tax. However, the mortgage lender wants you to have high net income or at least enough net income to qualify for the mortgage that you want. If you know you're going to be buying a house in the next couple of years and your tax returns don't show enough net income, then that's a conversation you need to have with your tax preparer. So how does a mortgage lender typically calculate Schedule C self-employment income? Well, on this entire form, page 1 and page 2, in reality, there are only 5 lines that count. The first of the 5 lines that count is line 13, depreciation. Now, what's that? Well, it's a reduction in the value of an asset over time, typically through wear and tear. Normally, this refers to some kind of business machinery. So, for example, let's say the business buys a machine, puts it in use in 2020, and the IRS is going to allow a 5-year depreciation period. Let's say the price of this machine was $11,000, and the estimated salvage value is $1,000, so the cost to the business is $10,000. So what depreciation allows that business to do is write that $10,000 expense off over 5 years. They write it off $2,000 a year, and then that is the amount that goes in line 13. Now, 2 other lines on your Schedule C form that you need to know about are line 9 and line 44A. The IRS allows you 2 different ways to figure your car and truck expense. You can either use a standard mileage rate or you can use actual expenses. There are advantages to using the standard mileage rate. It varies every year, but in 2023, they were allowing 65.5 cents per business mile. So to figure the car and truck expense, you simply count the number of business miles, multiply it by the rate, and come up with the expense. The advantage to using this method is if you do, in most cases, the lender will add back 1/2 of that expense to your net income. So to maximize your net income that the lender is going to use, I'd recommend this method. I'd also like to draw attention to line 24B, deductible meals. This refers to business meals. Now, traditionally, the deduction has been limited to 50% of the cost of the business meal, meaning if the business meal cost $100, you could only deduct $50 from your income. However, there are two exceptions. In 2022, an economic stimulus plan allowed you to deduct 100% of the cost of business meals. And in 2023, if you're an over-the-road truck driver, someone involved in long-haul transportation, you can normally deduct 80% of the expense. But if we assume 50%, and most lenders are just going to assume that this deduction is 50% of the expense, what they'll do is they'll take the other 50% of the expense and subtract it from the income that they're going to use because they're assuming that this deduction is understated. Now here is where it all comes together. I'm going to explain a simple 4-step process that most lenders will use to determine what income that they're going to have to qualify you for a Schedule C self-employed borrower. The first thing they'll do is look at line 31 on your Schedule C, which is your net income. They'll start there. Then they'll look at line 9, which is the car and truck expense. And then they'll look on line 44A to see what if you took the IRS standard mileage rate. And if you did, they'll add half of that back. So now we're up to $37,500. Next, they're going to look to see if you took any depreciation. And in this example, there was $10,000, so I'll add that in. And finally, they'll look at the deductible meal expense on line 24B. Now, assuming that that expense is only 50% of the cost, then they'll subtract that expense from the income and come up with a final number of $42,500. Once again, I can't promise you every single lender will do it this way, but it should be something close. And finally, I think there are a few other things that you need to know about Schedule C self-employment income and how a mortgage lender is most likely going to count it. The lender is going to average the income that they come up with over the last 2 years, 24 months. You need to be self-employed, Schedule C, for 2 years. And normally you need to have 2 years of completed tax returns to give to the mortgage lender. Being self-employed for less than 2 years or having less than 2 years of tax returns could be a big problem. And then finally, if the income, the net income on the most recent tax return has declined from the previous year, especially if it is a significant amount, that could be a problem. If the lender believes that you've got this declining income and they think it's significant, and it is somewhat subjective as to what their definition of significant is, the mortgage company might not count any of the income at all. Or they might only look at the most recent year, the lower of the two, and just count that one. There are possible solutions if the loan is going to be declined over declining net income. Now, they may not apply, but if they are there, they need to be pointed out. The first one is, did the gross number increase from the previous year to the most current year? And it was just the net number that dropped. And did the net number drop because the business had some sort of unique and extraordinary expense? For example, maybe their sales grew and they needed to move to a larger location and they had a number of moving expenses and that was a one-time deal. If that is the case and those expenses are the thing that caused the net income to decline in the most recent year, then that needs to be pointed out to the lender because you may be able to get around that problem. And then secondly, if it's late in the year, for example, I'm shooting this video in October of 2024. So if the income on the 2022 and 2023 tax returns declines significantly, one question that I'm going to ask as a loan officer is, has your income gone up this year? What does it look like through the end of October, for example? Now, in order to prove that, since you can't do a tax return yet, you're going to have a CPA prepare a financial statement. It doesn't have to be audited, but it needs, in most cases, to say something about the CPA preparing it, examining your books, and coming up with these numbers. If you can get that, it might be possible to use that to overcome this problem. Thank you very much for watching this video all the way to the end, and please help my channel by hitting like and subscribe.